Hello, and welcome to Macro Minutes. During each episode, we will be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures.
Hi, everyone. Welcome to the October 25th edition of Macro Minutes, entitled Let's Get Restrictive. With most central banks at a maturing stage of the hiking cycle, terminal policy rates are firmly in focus. The BOC and Fed are poised to move into clearly restrictive territory in upcoming meetings, while next week's BOE meeting comes after more than a month of fiscal policy-induced volatility. And a 75 basis point hike from the ECB seems all but assured on Thursday. Outside of rates, FX moves have been outsized, and attention on commodities remains with implications for inflation. To provide some insights on this landscape, we have a full lineup of RBC experts. Peter will kick off with the latest from the UK and this week's ECB meeting. Elsa will provide an update in FX space, and Blake will discuss next week's Fed meeting and views on the Treasury market. I'll look at tomorrow's Bank of Canada meeting with implications for terminal rate and curves, and Michael will conclude on the oil market dynamic, the fundamental push versus the policy pull. With that, we'll start with Peter. Over to you.
Thank you, Simon. What I'll try to do in the next 2 or 3 minutes is, first of all, give you a little bit of insights on the latest moves here in the UK and the implications for markets. And then secondly, as Simon was alluding to, speak about the upcoming ECB meeting. So first of all, I guess one of the things that you have undoubtedly noticed is that the political leadership here in the UK has changed once again, and it has been relatively quick. So the previous Chancellor, not the previous, but the prior Chancellor, Rishi Sunak, is now the Prime Minister, and it seems likely that he will leave the current Chancellor in office. He gave his first speech, but we don't really know all the details about what they will do in terms of fiscal policy. But the key thing is that they seem to be radiating a little bit more competence, seem to be radiating a little bit more respect for the market, and seem to be also radiating a willingness to have, say, at least a little bit more grips on the budget itself and the amount of borrowing that is required. And you can see that in some of the announcements that have already been made. For instance, in the tax policies that have been announced, or for instance, in the changes to the energy support package. Now, how that all plays out over the medium term remains to be seen. But I think the key message here in the here and now is twofold. First of all, the market seems to take the change in leadership as a positive. Whilst markets are still relatively volatile, yields have come down. The volatility, despite still being relatively high, has also come down. And I think it seems also clear in the currency market, with the recent re-strengthening of sterling to some degree, that the market is taking a little bit of heart here. Now, some of the structural factors for the UK and the UK economy and the UK fiscal position certainly won't go away, but the air of at least having a somewhat more competent leadership in place is helping markets here. Now, what does it mean for us in terms of positioning? We have argued for quite a while now, over the last 2 weeks, that was priced in the front end of the UK curve in particular, where at one point we were pricing short-end rates over 6% as a response to the instability that we had was exaggerated. We think that currently we are better priced, but probably still exaggerated. We have been long in June 23 SONIA futures, and we remain long here, and we think there's another 50 basis points probably of profit to be made. Now, shifting gears a little bit to the ECB on Thursday. As Simon was alluding to in his intro, it seems very likely that the ECB will hike rates again by 75 basis points. And in my mind, that's not necessarily what's going to move the needle. The two things that, in my mind, have a much larger propensity to move markets are, first of all, how are they guiding markets, if at all, going forward? How are they treating in the press conference, in particular, sort of the question about where they want to get to? Last time round, we didn't learn a lot because Lagarde has been quite evasive. Previously, she said they want to get to neutral, but hasn't sort of put a number to that. Will they do anything like that? Because at 150, where we're most likely going to be in the deposit rate, we're probably still quite at neutral, but we're closer to numbers that have been handed around, such as 2% or slightly above 2%, and the market is still implying something around 3%. So also here, we think that the front end provides value. We don't have the same kind of positioning on as we have in sterling because we think the opportunities in sterling are greater. But also here, I think there is potential for the market to recover some of the losses that we've seen over the last couple of weeks. And then the second point, and that's my last point I'm going to make, as far as the ECB is concerned, what else is in store? Well, there has been a lot of talk about changing either the remuneration of reserves or changing the TLTRO details, how the banks have been borrowing from the ECB, and that is something of a bit of an unknown. It has already created quite a lot of volatility, both in the front end, in repos, as well as in the basis markets. And this is really something that we should be paying close attention to. What is the ECB's intention here? Will they allow a negative tiering, for instance, or will they maybe change retrospectively the details of the TLTRO and cause fairly significant early repayments? All of these are quite unknowns. The market doesn't have a good steer, so I think this is something that could cause a volatility, and we should be paying close attention to when the details will be announced. And with that, I'll probably leave it and hand it back to Simon.
Thanks very much for those insights, Peter. Now we'll shift to Elsa on FX.
So from my side, I'm just going to say a couple of things on currencies heading into this week's central bank meetings. And we're working on a piece at the moment which will be published in your inboxes very soon, looking at something that we've heard anecdotally, both from our traders internally and also from clients. And that's the sense that G10 FX is not really trading off of short-end rates like you would expect. In fact, if you look at the correlation between dollar pairs and foreign yields, so dollar CAD against Canadian yields or euro dollar against European yields, we're finding that the correlation is positive. So the dollar is actually outperforming when foreign yields are going up, the complete opposite of what you would normally expect. We think that's a function of two things. One, US yields are highly correlated to yields in the rest of G10. And two, US yields are driving the dollar higher against the rest of G10, so by extension driving that positive correlation between the dollar and non-US front-end rates. What does that mean for, say, CAD going into the Bank of Canada tomorrow? Well, the decision is finely balanced, and I know, Simon, you'll have more to say of that in a bit. But analysts are split roughly 60-40 in favor of 75 beats. Either way, there should be some reaction, but dollar CAD may not be the best way to play it. If you look at CAD correlations on the crosses, Aussie CAD, Euro CAD, Sterling CAD, CAD Stocky, there you find a stronger impact for Canadian front-end rates. So we've gone with short Aussie CAD as our trade of the week, heading into Australian CPI tonight, Bank of Canada tomorrow. But of course, you could be looking at Euro CAD or Sterling CAD, depending on your underlying bias. I'll leave it there and pass back to you, Simon.
Thanks very much, Elsa. Moving to Blake now on the U.S.
Hey, thanks, Simon. So yeah, we've basically got two kind of events coming up next week that are really in focus for the U.S. That includes obviously the FOMC on Wednesday, but actually earlier on Wednesday we will also be getting an announcement from Treasury for their quarterly refunding process. First with the first with the FOMC, we've entered the blackout period. We're holding on to kind of terminal ceiling at 5% and 10s at kind of 4.25 ceiling until then. I think markets have essentially locked in the 75 basis point hike for this meeting. Remember, we won't get any SEP update, at the meeting next week. So I think all the attention is really going to be on Powell's characterization of a potential step down or slowdown in the pace of hikes. The focus on this topic has grown a lot heading into the blackout period. We had some dovish comments from Brainerd and Deeley. There's also an article from the Fed Whisperer himself, Nick Timros, at the Wall Street Journal. They kind of suggested there would be a debate about the pace of hikes at next week's meeting. So I think that's got a lot of people kind of looking to this to see some kind of guidance on, whether they're going to, start to step down that pace and hikes at the December meeting. However, I do think Powell's going to be hesitant to say too much, particularly with two CPI prints between now and the December meeting. I don't think he's going to want to lock himself into any course of action and probably try to spend most of the press conference avoiding those kind of dovish pitfalls in the way that he did fairly successfully at the last press conference. I think the one difference here, though, is that if there is kind of a growing chorus of dovish members who do want to see some kind of step down in the pace, When he speaks at these FOMC press conferences, he is speaking on behalf of the committee. So, there's a possibility in kind of wrapping in those discussions and giving some kind of weight to all the views being kind of presented at the table, that those comments could come off a little bit dovish, in that he has to give some kind of nod to those wanting a step down, and markets could interpret that as his view or even the core view, and I do think that's probably the dovish risk coming out of that press conference. Turning real quickly to the refunding meeting, I'm not projecting any more cuts to coupon auction sizes. Recall that over the last year, all 4 quarters, we have seen pretty significant cuts to coupon auction sizes. I expect that campaign is basically over starting this next month. That also, I should note, includes 20s. A lot of focus on the 20-year sector. It has been targeted for larger cuts than the rest of the sector, and I think there's some thought out there that maybe the Treasury would continue to cut those auction sizes, but I have those stopping along with the cuts to the rest of the curve. Given that there won't be, in my view, any changes, to auction sizes, I think most of the focus is going to be on potential for a buyback program. A lot of chatter about that after Treasury asked about potential buybacks in the dealer refunding survey that they sent out last week. Really got kind of that market conversation going around the possibility they'd be coming in and doing buybacks. My view is that, that question on the survey was likely more exploratory. I don't think they're, kind of on the precipice of announcing some major buyback program. And even if they were to give some guidance on how they may use buybacks in the future, I think it's probably going to be less than what some market participants are likely getting excited about, which is probably more of a regular, steady program where they're in kind of a day-to-day, much like the Fed was during QE, buying off the run securities and kind of bolstering day-to-day liquidity, the day-to-day liquidity conditions. But I think it's probably, even if they were to do something, it'd be something much lighter than that. So that's it for me, and I'll pass it back to you, Simon.
Great. Thank you, Blake. Very useful. Now shifting to Canada, as Elsa said, meeting this week on Wednesday, one of the most difficult to call in the cycle, we think. We're on the lower end at 50 basis point hike, while market pricing and consensus has shifted to 75 following communication from Governor Macklem earlier this month, and also last week's September CPI report. Supporting our view for 50 basis point is that the macro backdrop has likely evolved pretty close to the bank's expectations since the September policy meeting, with headline inflation moving lower, 6.9% currently, and underlying inflation showing signs of stabilizing around 5%, though both certainly remain too high for the Bank of Canada to be comfortable at those levels. Medium-term inflation expectations are similarly too high, though with some early moderation visible in recent Bank of Canada business and consumer surveys. Moreover, we think 50 basis points at this meeting gives the bank sufficient flexibility at subsequent meetings to maintain that size if progress on inflation is slower than anticipated, or continue to reduce the increment with 25 basis points in December if they feel like progress is sufficient. Into restrictive territory, even 50 basis point increments provide a better ability to calibrate policy than larger hikes such as 75. Support for a 75 basis point move comes from the level of inflation outlined and an economy still deemed to be in excess demand, so in other words, domestic sources of inflation pressures. The currency depreciation is a new factor that the bank has highlighted and adds to inflation concerns modestly, we would say, but we'd argue it looks less on a trade-weighted basis than just against the U.S. dollar. For terminal, we do think a 75 basis point hike opens up a likely path to 4.50 to 5% for the terminal policy rate, with a gradual step down, say 50 basis points in December, 25 basis points in January, resulting in a 4.75 setting. So that gets them to quite an elevated policy rate by that time. Is the bank convinced that they need to take it there at this stage? One thing that stands out to us in rates market is that despite the yield move higher, curve inversion, so 2s10s around minus 63 basis points as I'm talking, is not the most pronounced it's been for the cycle. If the bank does deliver a 75 basis point hike and is on a path to 4.50 to 5% on the policy rate, then that will increase the pain on the activity side, the output side, and could easily result in inversion pushing 100 basis points, as has been seen in earlier high inflation periods. And to finalize things, we have Michael speaking on the oil market. Over to you, Michael.
Look, there's clearly a lot of macro-driven factors impacting the oil market, and we see a lot of chop in the push-pull between what we're calling a fairly strong oil market fundamental backdrop versus the soft economic backdrop that those on this call have been highlighting. So I think the key question is we're trading in the low 80s right now for WTI. We anticipate that prices will likely just chop around this level in a fairly wide range. But I think it's fair to really highlight how do we get here. So I think there's been really two oil markets so far this year. First half of 2022, what we saw was a fundamentally driven market. We really looked at supply, demand factors, inventories, crack spreads really driving oil market sentiment, oil market direction. Come Q3 of this year, what we saw was a market that's been entirely policy-based. So what I mean by that is we went from OPEC and a loosening policy to a tightening policy in just a very short couple of months. We saw the Biden SPR program in the biggest volumes we've ever seen. You know, there's headlines about the EU embargo on Russian energy, price caps, to China's COVID-0 policy, to Iranian nuclear talks, to, of course, the Fed. All of these are major swing factors for the oil market, but they're all driven by policy and less driven by fundamentals. And oil market participants loathe trading off of a policy-driven market and would rather trade a market that is focused on following the barrel, being able to count the barrels, and understand the supply and demand factors. So what we've had here over the course of the past 3 to 4 months is a very high degree of what we're calling policy paralysis. And this leads to a high degree of positioning paralysis. What we've seen is liquidity in WTI is about 40%, 42% below normal over the course of the past 3 to 4 months. And when you get, low volumes throughput traded, what happens is you ultimately get a low degree of or a high degree of volatility. Now, I think there are two oil markets right now as well, the near term and the medium term. We continue to be constructive the cycle over the medium term. There's little that can change our mind about that, just given the fundamental setup for the next several years. But over the very near term, we do strike a cautious tone here. I mean, you simply just have to respect the macro backdrop. What we have going into next year is a fairly sluggish growth theme. We see oil demand growth at about 700,000 barrels a day or so, which, save for the COVID year of 2020, we haven't seen a year like this in quite some time. Now, in a recessionary scenario, we think that there's scope for prices to move potentially down to the low 60s, which is about $20 lower from where we are now. Just to give everybody a sense of framework here, in 2008, that recession, what we saw was we lost about 2.2% of global oil demand, and we saw demand contract for 5 quarters. Now, my main concern here in the global oil market that's different than recessions in the past is that in this downturn, we do not have the backstop of China, just given the zero COVID policy. Now, China's really pulled us out of almost every soft oil demand backdrop over the course of the past 20 or 25 years. But at this point, it's difficult to see that there's a natural buyer of last resort if China is not there. And rarely in our careers have we ever seen a strong oil market and a weak China at the same time. But with that, why don't I leave it there and pass it back to Simon.
Thank you, Michael, and thank you for joining us for Macro Minutes.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.